Okay, morning guys. Let's just have a look at what's going on then. Get ready for the rest of the session. Now let's just talk about the moves we've just seen first. So here we need to just focus in on the equity space actually. So let me just change a couple of these charts. Top left, Euro stocks have just taken a drop over the last 10-20 minutes or so, stabilizing a little bit, but just breaking lower. On the DAX top right, similarly a bit of downside. If we have a look at the S&P bottom left, shorter time frame now, over the last, well, through the Asian session we've been drifting lower, and then just a bit of a pickup and a new break lower just after the European Open, down onto the pivot now. So a couple of things really. I think if you look at the S&P drifting lower through the Asian session, we'll talk about the EU summit in a minute, but the key news that just led to that pop lower there was as a result of this, which is a chart of the yuan versus the US dollar. And if you've been keeping an eye on your headline feeds, then we had a source's comment saying that the PBOC, the People's Bank of China, are willing to let the Chinese yuan fall to 6.8 versus the US dollar. This is look where we are on the right hand side y-axis. You can see where we're trading here. Just before this news we were trading at 6.66, and just give me one sec, so I'm going to repost my screenshot. So we were trading at 6.66, and then you can see that we've spiked quite dramatically to the upside. You can see that we've reached 6.687 here as it stands, a sharp pop higher. Obviously those sources comments suggesting 6.8, so obviously more room to move. Now this is important because of how the value of the Chinese yuan versus the dollar and the actions of the People's Bank of China have been the trigger point for probably the two biggest episodes of global market volatility over the last 12 months, apart from Brexit. And actually, in some cases, in terms of global markets, actually the Chinese yuan being devalued sharply, like has happened here on this chart. This thing moving up, that's Chinese yuan devaluation, that's dollar appreciation as a result. This has been way more influential on global markets than the Brexit has been so far. Here's a long-term chart of the Chinese yuan versus the dollar going back over 10 years here. And let me just lift that. So you can see the x-axis. So you can see that 6.8, the last time we were at 6.8 on the yuan versus the dollar was actually August 2010. So here we are now, new 6-year high, and room to move higher apparently. So this is China, I guess, continuing to make this move, continuing to join and participate in the global currency war, trying to engineer a cheaper currency. Their currency's pegged to the dollar, of course, so as the dollar appreciates, this means their currency appreciates against others, against, let's say, the other Asian currencies, and so this is undermining their export competitiveness. So this is important. So we just had a little blip of risk off, you'd probably call it, off the back of this, with equities just taking a dive, although things are settling down a little bit. So we'll see. Now, EU summit last night, or not last night, yesterday, continued without Cameron, and it's just literally the first EU summit without a British Prime Minister for over 43 years. Okay, it was the last time that the Europeans had a summit without Britain. Now, a couple of comments from that. So firstly, Tusk, he's the EU Council President. He said there'll be no single market a la carte. What he means by that is that the UK are not going to just be able to leave the EU and then just renegotiate deals and cherry pick the best parts of being a member of the EU and not have to contribute in other ways. So other stuff. And here's an important line. So actually this was added in unexpectedly From a journalist's point of view, this line was added in unexpectedly, and apparently it came with explicit consent from Merkel. And the line that got unexpectedly added to the statement yesterday was that access to the single market requires acceptance of all four freedoms. Now, the four freedoms of the EU sort of treaty are the free movement of capital, the free movement of labour, the free movement of services, and the free movement of goods. So just reiterating the fact that, look, well, really just reducing the chances, it seems, that the UK are going to be able to kind of do some kind of deal here. So we don't actually leave, but we get control on migration and continue to enjoy all the benefits of the single market. So it looks like these European leaders are, just, well, as I said yesterday, they don't want to set a precedent here. They don't want the UK leaving and continuing to enjoy all the benefits, because obviously then everyone else is going to want to leave as well. So they've got to be quite careful, and I think it's not surprising they're going to play hardball first. So perhaps just a little bit of a very small amount of clarity coming through on this. But as everybody's saying, the problem with this situation is we're not going to get any news and developments on this, any significant ones, for a very long time. So here's a look at the timeline, and actually let me show you something first. I'll show you a couple of screenshots. Here's a look at the timeline of how these things might develop. Look at the timeline along the top here. So we voted to leave. What's going to happen next is we're going to have a Conservative Party leadership race, and as it stands, Cameron's not going to evoke Article 50. He's going to leave it to his successor. So when will his successor come? The Europeans were trying to urge the UK to kind of get on with it and trigger this article as soon as possible. But when will that be? So the leadership campaign will start. And here's actually, I had a good graphic for this. Let me just find it. Here's a look at how the leadership race happens. First, all the candidates line up. Now, if there's more than two, then the process is a lot longer. It's basically a double vote, and there is more than two. We definitely know there's going to be four. So this will be Theresa May, Boris Johnson, Liam Fox, and then a Welsh MP called Crabb, who's much lesser known, but he's already put his hat in the ring. May and Johnson are going to join the race today. Osborne's out. So we're going to get more than two. So this means you're going to have a first round of voting, which then leaves you with the two best candidates. Okay? Once you've got the two best candidates, you then have a second round of voting. Then you get your actual leader. All right? So we're definitely going to have a double round of voting. This is why it's not going to be done anytime soon, and we're going to have to wait till September at the earliest. Now, let me go back to that Deutsche timeline. Here we go. So once that's happened, just around that kind of time in September, it's then almost pretty much straight away that we have the Conservative Party conference, the annual Conservative Party conference. So I would say you're not going to get enough time between the end of this leadership vote and that conference really to kind of the new leader to settle in and trigger the Article 50. So it's almost certainly, I would say, Article 50 will not be triggered until after that Conservative Party conference. And so that puts us into October. And so and then, they're going to prepare for negotiations before triggering the article. So I would say at the best, you're basically looking at year end. Then that only triggers then the beginning. Then you have this 2-year period. That's what Article 50 is. It triggers a 2-year countdown where then formal exit talks begin, with the idea that you're wrapping up those talks and a deal is done and Britain actually exit 2 years later. So you're looking, I would say, at the very earliest, if it happens, you're looking at the end of 2018 until we actually leave. So everyone's kind of scratching their heads a little bit and saying, well, hang on a minute, why have equities rebounded? Check out this chart. And I guess this is the headline grabber. We've got a few equity indices on here, FTSE 100, FTSE 250. We've got the Euro First 300 and then the DAX. Now, obviously, quite a bit of divergence now having all sold off in one line all together on Friday, you then had a very different set of performances. And look at the FTSE 100, and the headline grabbing moment came into the close last night, where the FTSE 100 traded back up above the pre-referendum vote. So the FTSE 100 is trading higher than it was before the vote. Now this is just weird, right? Well, on the one hand, there's two reasons why this has happened. Number one, as I've already said, the FTSE 100 generate 80% of their revenue internationally. So you've got exporters here, and if the pound drops, and it has, the pound's 10% cheaper, then in theory this is good news for exporters. You know, we've looked at some charts where, check out AstraZeneca's share price, for example, which is actually trading quite a lot higher than it was before the vote. Unilever's share price higher than it was before the vote. These are defensive stocks, plus they're also big exporters, so benefiting from that cheap pound. Now, there's an argument to say that actually a cheap pound isn't necessarily good for all exporters, and that's because of the nature of the products that are being exported. You know, some UK manufacturers, you know, their products are very what are called kind of high value added products. These are you know, at the top end of the expertise spectrum. Now, these products, the prices of them, they're not that price sensitive. It's very much driven by demand. You can't get these products anywhere else. And also these companies, because of the complex nature of the products, they often get manufactured here in the UK, but actually a lot of the components are sourced from international suppliers. So actually I know of a UK manufacturer, I know very well of one who actually, even though they manufacture stuff to the world, they're actually worse off because most of their components are sourced in the Eurozone. So here now the pound's collapsed against the euro, so all their components are a lot more expensive. And they're not necessarily going to see a pickup in demand for their product, because really the demand for their products is more driven by global growth rather than price, if you see what I mean. So that's just something to have in the back of your mind. But look, for now, you've certainly seen the FTSE 100 benefit greatly from the fact that it's a defensive index anyway, but you know, the performances of these big defensive exporters has kind of outweighed the negative performance of banks. You've got a lot of banks in this FTSE 100, and yet even with the banks, it's managed to rally back. So this is impressive stuff. Look at these other indices, though. Of course, they're still well down. So the FTSE 100 is a little bit unique, and it's kind of grabbing the headlines here. But don't think this means, you know, actually we're fine. A Brexit's going to be no problem. In many ways, you know, you could say from the negotiation point of view, this is good news for the Brexiteers. Because you could say Boris is going to come out and say, oh, look, Boris is going to join the leadership race today, and you can bet your bottom dollar he's going to be talking about the FTSE 100. I absolutely guarantee it. He's going to say, well, look, it's back to where it was. You know, that fear-mongering from the Remain campaign was nonsense. This is the kind of angle he's going to be taking. It gives him more justification, I guess, for being on the Leave side, and this might help him in the leadership race. We'll have to wait and see. So this is all the stuff that's going on. Also, consumer confidence data out of the UK last night, nosediving, lowest level for 3 years, as you might expect. Other news, we've had the Fed with their US bank stress tests. Everybody passed the bill apart from a couple of subsidiaries. The Deutsche Bank and the Santander US subsidiaries did not pass, which they haven't done for the last few years anyway, so it's not a big surprise. All the big banks in the US, again, signed off and are able to return money to shareholders. This is the thing for these banks. If they pass the stress test, they're able to continue with things like share buyback schemes, things like dividends and so on. So that's been happening, although it hasn't really seen any daylight in the headlines here in Europe. So let's have a look at some of the other markets. Let's look at the pound. That's lifted we've come off overnight off those top, but actually so far I would say the pound is still consolidating from the big collapse. Here's a daily chart. We're still consolidating at the bottom. The highest we've been since the collapse was 135, just above the 135 briefly yesterday. I'm surprised, I guess, that actually we haven't had any negative response to some of those, to that EU statement. I thought that EU statement, the way I read it, was, well, less chance of Britain doing a deal here and actually staying in. But that doesn't seem to have been reflected much in markets here. So you're still getting this kind of dust is settling scenario. It is quarter end as well. That might be something to think about with these equity markets being weirdly propped up, as you need to have quarter end rebalancing of portfolios. And if your equity portion of your portfolio just suddenly dropped sharply as equity markets collapsed, well, then you need to top up your equity portions to get your weightings back into line with benchmarks. That involves buying equities. So that might be a story that's just helped things here over the last, this week, over the last 3 days. It'll be interesting to see what happens tomorrow, because actually tomorrow is the first day of quarter 3. So will this result in tomorrow being the day where this kind of weirdly calm and positive equity mood suddenly reverses and we get back on track to panicking about Brexit? We'll have to see, but keep that in mind. It is quarter end today. Okay, finally, let's just have a look at the data calendar for what it's worth. And we've had a lot of Japanese stuff already overnight. UK final reading on quarter 1 GDP, that's coming at 9:30. Not that this is in any way important at all. It's not about quarter 1 in the UK. It's not about quarter 2. It's going to be quarter 3. What happens to growth? Well, actually, quarter 2 is important because we were expecting growth to slide slightly ahead of the vote because of the uncertainty. But what's going to happen in quarter 3 is the key, of course. What is the real, genuine effect on the UK economy after the Brexit vote? So this quarter 1 data is not important. Other stuff, we got some inflation numbers for June, some final readings on inflation out of Europe at 10 o'clock. Into the US session, and we got continuing claims and jobless claims. Chicago PMI is probably the pick of the bunch there. So Chicago PMI coming at 245. Other than that, we got some usual. We've got Bullard speaking, but that's not going to be till after the European close. Final comment on crude oil before I let you get on with it. Punchy day for crude yesterday. Big move to the upside. Tested $50. We just failed at $50. This was off the back of the bullish inventory data from the US Department of Energy, plus a continuation of the downtrend of the overall US crude oil output. And so we're flat since then. Tested the pivot so far today, but keep your eye out for another test of the $50 handle. Of course, that's important. Right, I'll let you guys get on with it. Enjoy the session.